Good evening, ladies and gentlemen, boys and girls. Welcome to another edition of our webinar series from Axis Mutual Fund. Now, before we get into the topic of the day, I just want to tell everyone on this call or everyone on this meeting, if you're watching this on YouTube, you can go to the comment section and add in your questions. If you joined this meeting via a link you would have received on WhatsApp or on email, you would see a question box to the right side of the player. So please feel free to add as many questions as possible, and we'll request Divya to indulge us with the answers. Before we further get in, I would also like to tell the ladies and gentlemen here that you can always, in case you want, insights, such content, etc. You should definitely visit our website, axismf.com, or download our mobile app on the Android App Store and the Google Play Store, etc. So without further ado, let me introduce Divya. So Divya is a senior product manager and has over 2 decades of experience in this space. And essentially what we are here to do is to pick her brain on the most talked about topic in the last 24 hours, which is the union budget for 2024. So Divya, without further ado, let's get to your views. Let's get started, and then we'll start up a Q&A.
Okay. Thank you, Siddharth. Just a small correction. I'm not that old. I only have 15 years of working. But yeah, thank you so much for the introduction. So let's start.
So Divya, before I ask some questions, maybe let's get your views on the market outlook. Where do you think? What do you think about the markets? How did the markets react yesterday? We saw some volatility uh, in the equity segment, but if you could give us some more details, what are your views on the macros, on the micros?
Yeah. So yesterday the markets were definitely volatile once the budget, especially when the capital gains taxation part came up. Markets reacted negatively, but the day ended with not much change in the markets. They were just marginally negative, not the steep negative that we saw, the knee-jerk reaction that we saw yesterday. In between, that was more or less covered up by the market. Somewhere I think markets realized that the government third term, it has tried to balance, continue the balance between fiscal prudence and the expenditure. So that saved the day. From the equity market perspective, we think that markets, one needs to be cautious. Markets could be volatile. There's no doubt about India's growth story. Okay, from a medium to long-term perspective, we are optimistic about India growth story, what an equity market allocation can do to your portfolio. Nevertheless, in the near term, we would want our investors to be cautious with respect to their equity allocation. What we have seen in the past, the stellar performance of the equity markets may or may not continue to reflect in the future. So you need to be cautious about that. One thing that we have been hearing for some time now, it's also our view, is that markets are rich. So on a broader level, across segments, across sectors, we have seen very rich valuations. So you need to take that into account. Sectors and segments that have delivered on growth, there the multiples are very high. There are segments where the multiples are not as high, but these are also segments that have not delivered on growth. So there are cheaper segments in markets like FMCG segment or a private banking segment, IT segment. These look decent on the valuation perspective. But like I said, overall, in our view, we have been overweight the industrial segment and the consumption segment, specifically in the discretionary sales space for some time now. We continue to hold onto that. On the export segments, we are not that constructive, so we would be marginally underweight there in that segment, and our portfolios continue to reflect that. So that's our view on equity market. Debt markets yesterday, I think what they were anticipating, that's how it turned out. Fiscal consolidation path is very, very critical from a debt market perspective. And we saw that government delivered on it. The fiscal path, the decline of fiscal deficit, that continued, and definitely debt markets draw comfort from there. So we did not see much of any significant movement there. For us, it turned out to be like we expected, so we continue with our stance. We are constructive on rates. We expect over the next 3 to 6 months, interest rates would come off. Duration, wherever our schemes permit duration play, we are high on duration. I think for us, few of the parameters that work in favor of our constructive view is obviously the discipline on the fiscal deficit plan, coupled with optimism on FPI flows, because India now recently got included in the JP Morgan index. And there are news of its India finding inclusion in other bond indices also. That, coupled with our stable external current account balances, our fiscal balances, and generally there is a sense that there will be rating sovereign outlook by the rating agencies, foreign rating agencies, there would be an upgrade there. All of these bode very well from a debt market perspective. So we remain constructive on the debt market segment. And we do expect that the 10-year bond yields currently might trade in a narrow range with a tendency to soften to say 675 over the next few quarters. So that's broadly a gist of our outlook on equity and debt markets.
Thanks for that, Divya. So I think the day, if I may just take a second here, yesterday, I think once the budget started, a lot of, we could see a few bears on the market, right? We're trying to redo what happened on the election result day, but I think the day ended quite significantly, bringing back whatever had been lost in the initial of trading. So Divya, I think we've seen a few questions come in already. In fact, we have close to 1,000 questions. So I will try to indulge you as much as possible. And the folks on the call, don't worry, in case we're not able to answer your question, please feel free to write to us also. You can tag us on social media and we will for sure get back to you. Yeah, without further ado, there's this question from Mr. Mahesh from Mumbai saying if you could share your 3 key takeaways from the budget that you would want to highlight. And Mr. Mahesh looks like he is an avid investor with multiple holdings across equities. So if you may.
Okay, so firstly, the budget, when it came out, it was more like a continuity of the previous budgets that we have seen. So there were concerns in some segments of markets that because it is the first budget from Modi government in a coalition form, there could be some form of populist measures, party pleasing measures, a free run on subsidies or such kind of expenditures, but those concerns were laid to rest, and I think it was a fine balancing act by the government where it tried to balance the fiscal part with the expenditure part. So that is one very good takeaway for me, because that means that over a medium to long term, or in that time frame, there is a sense of macro stability. So that's one takeaway. The other is, like I've been mentioning for some time now, is the fiscal prudence. So FY24 started off with a 5.6% fiscal deficit. The interim budget had a fiscal deficit projection of 5.1%. but this budget, now we saw it come down to 4.9%. So that's a 20 basis point reduction. So that also speaks a lot in terms of the confidence that both equity market as well as debt market can draw in terms of the government continuing its path of fiscal consolidation. So it matters for in terms of macro stability, in terms of stability for capital markets, be it equity market or debt market. So that continuity, that fiscal prudence is another key takeaway for me. Finally, something which many of us had anticipated, and I'm very happy that it happened in the budget, is specific focus on youth. So we are a country of young population, right? Majority of our population is working population, and in that too, if you we keep hearing about this word demographic dividend. So that means that our population is young. Our median age for our country is 28 years. That means bulk of my population is 30 years or younger. And for this population, it becomes very critical that we make them employable, we develop skills in them, and then we give them employment opportunities. I think budget has clearly had youth at its center in terms of the packages that it has come out with. So the PM package has some 5 schemes in it, which specifically focuses on employment, skill development, employability of the youth, some 2 lakh crores of outlays. It's spread across the 5 years. But yes, the youth forms a core center of the budget, and there were 9 priorities in this budget, which the finance minister has stated would be the priorities in the coming budget too. So that gives comfort that the focus on youth will be there. And it is very, very critical for a young country like India that we give them that opportunity. So that has been one of the biggest takeaways for me in this budget.
Thanks, Divya. And I think, which adding to your point, where I think there was a lot of impetus given on manufacturing, on creating employable youth, on vocational training, etc. Right.
Absolutely.
So I think that does.
Yeah. So first time employees, in fact, employers are also being incentivized for these kind of efforts. You have a very beautiful internship schemes being planned for them, where youth can participate in over 500 companies in the next 5 years, 1-year internship program. So I think all of these, while it does not translate immediately into some benefit in terms of it is positive for this theme or it is positive for this sector, but over a medium to long term, this kind of focus will definitely help our country.
Yeah. I think that's a great thought, and it actually ties in really well to the Make in India, the whole impetus that was giving to manufacturing as a theme, right? Given we are such a populous country, and where both manufacturing and consumption are important themes for us.
Yeah. So speaking of manufacturing, so like I mentioned earlier, there were 9 parameters or priorities that the finance minister laid out in the budget. Manufacturing was in fact one of the 9 priorities in the budget. So there were quite a few schemes laid out to incentivize job creation in the manufacturing space. Especially a lot of focus was paid on the MSME segment, where there was incentivization via, say, credit guarantee schemes or credit support. Mudra loans were enhanced to 20 lakh. These schemes these proposals in the budget do show that government is focused on manufacturing. Although PLI, the production linked incentives, there was not much mention of PLIs in this, but overall, the overall layout of the budget did incentivize manufacturing, did incentivize job creation in manufacturing, some amount of custom duty exemption, custom duty cuts. These also make it competitive for our manufacturing sectors to be there in that segments. And in some ways also the raw materials or the capital goods that we use in our manufacturing segments, these also get some bit of boost. So that's broadly on manufacturing. Yeah.
Right. Thanks, Divya. Oh, we have a theme that's cuts across a lot of questions here, and I won't name anyone, but yeah, this was the whole talk of the town yesterday, right? The whole buzz around income tax and the change in taxation. So, Divya, if we can get your views on the change in the taxation system or the change in tax slabs, how does it impact everyday retail investors? How does it impact everyday life? If you could help us with some details on that.
Yeah. I'm sure you would have got tons of questions on taxation, because this has been the question being asked around us also, between us colleagues, in our families. So yes, that's interesting. So I have a document with me, Siddharth. If I can share it, I will share it. Let me just try sharing that once.
Yes, please.
Let me know if it is visible. It's a Word doc.
Yes, it's visible now.
Yeah. So on the taxation piece, before I get into this Word doc, so there has been some revision in terms of the direct taxation, something that will affect you and me. The tax slabs have changed. So the budget documents pegs it at a savings of 17,500 per year for us. And the standard deduction that we used to get in the new regime. So these are all changes in the new regime. So the standard deduction of 50,000 has now moved up to 75,000. So those kinds of some small incremental changes that would benefit us has happened in the direct taxation part. But more so, where the people are more interested in is the change in the capital gains taxation structure. So here, so broadly what has happened is they've tried to bring in uniformity in the capital gains. Some part of the market was already expecting that there will be changes in the capital gain structure. So some of the listed financial assets now, which previously when held for short term were taxed at 15%, will now be taxed at 20%. And uniformly, the long-term capital gains tax, they've tried to make it uniform. So 12.5% is the rate that now you will see uniformly across most of the asset classes as a long-term capital gains tax. Now the difference will come in terms of holding period. For some assets, specifically the listed financial assets and equity mutual fund, you will see that the holding period is 1 year. So in that sense, equity as an asset class still remains, attractive in terms of taxation, because the holding period is 1 year. This is important because for a country like India, where you have low single-digit participation in equity markets, compared to a country like US, where you have almost half of the population participating in equity market, it is critical that we make an equity investment attractive to investors. So that advantage is there. Now, if I move to the Word doc, it's visible, right, Siddharth? Yes. So what we have tried to lay, I will speak broadly only on the mutual fund aspect. Please bear in mind that we are awaiting our tax team to give us confirmation and a big thumbs up on this slide. Once we have their approval, we'll also be circulating it, and hopefully we'll be putting it up on our website also. But meanwhile, this is our understanding of how the taxation is currently, with effect from 23rd July 2024. So we'll speak about equity mutual fund first, which is what we cover here at the top row. Equity mutual funds are mutual funds that hold 65% plus in equities. So your equity mutual fund or any of your hybrid schemes that have 65% plus in equity will fall here. Your arbitrage funds, because they are hedged equities but have 65% equity, will fall here. So there the taxation is short-term 20%. Previously it was 15%, today it is 20% now. And long-term will be 12.5%. To qualify for long-term, you have to hold it for more than 1 year, which was same as in the previous year. Now the challenges start when we come to, say, a debt mutual fund or other mutual funds. So in debt mutual fund, what has happened is, before April 2023, we used to have indexation benefit. Since April 2023, that indexation benefit is not there. Now what happens is, with effect from 23rd July, you will have the taxation of long-term coming in for those investors who had invested before April 2023. So this is a piece where we are seeking some more clarity on, and this is based on our understanding. But once we get clarity and we are sure about it, we will host it on the website. Now, hybrid equity funds, there was a category, so anything that you buy now or you have bought after April 2023, the taxation remains same for, say, unlisted debt, debt mutual fund or market-linked debentures. It's that whatever you do, whether it is short-term or long-term, everything will be taxed as per your tax slab. That is as on today, if you were to invest in debt mutual fund, everything will be as per your tax slab. This is at par with what an FD would do with your, you would have to do with your FD investment. Now, the last year when the taxation change happened, there was a new set of category within the mutual fund space, which used to have equity less than 65 but more than 35. Those used to have the benefit of indexation. Now, if you're redeeming from such kind of instruments, the understanding is that after 2 years, you will have to bear a tax of 12.5%. Okay. Now, earlier, what used to happen is there were funds which were neither debt nor equity, in the sense like gold fund, gold ETF, silver ETF, international fund of funds. There, it used to be taxed similar to debt mutual fund. So whatever is your tax slab, you would be taxed as per that. Now, because there is a definition of debt mutual fund, which categorically states that debt mutual funds would be funds having more than 65% investment in debt and money market instruments, or SEBI regulated instruments, these funds don't fall with them. So there is now a carve out for these funds, if I may call it so, where you get some benefit of taxation. Now, they don't need to be taxed as per tax slab. In fact, from the next financial year, so this is applicable from the next financial year, they will no longer be taxed as per your tax slab, but after 2 years, you will get the long-term capital gains taxation of 12.5%. So this whole change in the capital gain structure, firstly, is to bring some kind of uniformity in the taxation, especially in the long-term taxation, where all your financial assets, in fact, all your non-financial assets also will be taxed at 12.5%. It's a mixed bag. For equities, there is small increase in long-term capital gains, some bit more increase in short-term capital gains. But some of the schemes, like I mentioned, gold, silver, international, for them, I believe it's a positive move because instead of paying your tax slab, now you will have a benefit of 2 years and 12.5% long-term capital gains. So it's a mixed bag. Markets did react sharply when this came up yesterday, but then, like I said, it ended up, marginally negative. So hopefully, while markets could be volatile for some time, people would digest this. And see, the beauty of capital gains is it will hit you only when you redeem. Till the time you are long-term investors, you are getting the compounding benefit in the Indian growth story. So that's how one could view it.
Right. Thanks, Divya. I think that actually makes a lot of sense as well, right? Because as a fund house, we request all of our investors, rather we suggest that they should stay invested for as long as possible to reap the benefits of compounding and the whole and being a part of the India growth story. And I think could it also be construed that these tax norms essentially trying to inculcate a habit of a long-term approach towards, especially on the equity side?
Yes. So that's a good point. In fact, I missed talking about it. Yeah. So firstly, the intention of the government, see the short-term gains, which is actually something that hits you if you are doing a lot of transaction, that has been increased. One thing which has been doing rounds for some time was the retail participation in the derivative markets, in the F&O markets, the futures and options market. So we have had regulators, we have had policymakers, all of them, raising concerns on possibility of speculation in this market, how retail clients are increasingly participating in derivatives market. So there was always this anticipation that there would be some kind of a rate increase or tax increase in this segment, and that has translated in yesterday's budget. So the budget proposed to hike the security transaction tax, that is the STT, in the F&O segment. So it has hiked it to 0.02% for futures and 0.1% for options trading. So that has happened. It was more or less in line with what markets anticipated.
Right. Thanks, Divya. So I think the next question is from Mr. Akash. It's from Pune. He asks, which sectors are anticipated to benefit the most from initiatives that have been outlined in the budget?
Okay. So manufacturing segment I covered, right, where the government has specifically focused on the MSME segment. These are the segment that would benefit from the budget, because budget really has outlays on those segments. Another theme which has been in play in the budgets for some time now has been that, just a second, I'll have to stop my screen share. Yeah, see that I've stopped my screen share, right? So another theme that can have some amount of pickup in because of the budget is consumption theme. But see, the point is there has not been direct dole outs for consumption sectors, okay, or dole outs to the investors in the hands of investors that then the investors can spend. But there is a multiplier effect that will play out for the consumption theme, in the sense, so I mentioned the changes in tax slab, the changes, the exemption limit increase. That amount of savings will translate into low ticket discretionary spends from an investors, especially the salaried class. That will again translate into some amount of consumption oriented spending. The focus on employment, continuation of policies towards, say, housing, rural, these also will have a multiplier effect on consumption theme. There has been, so out of the 9 priorities, agricultural resilience also is a priority. Agri and allied agricultural sectors, they have a dedicated earmarked outlay of 1.5 lakh crore in this budget. So that is also going to translate in terms of rural spending. So in terms of sectors that benefit from rural spending, it could bode well, say consumer staples or two-wheelers. So that's the multiplier effect that will work out on the rural segment. Then there have been focus on travel and tourism, some measures on certain areas have been targeted as a tourist destination, spiritual tourist destination. That again is an allied sector in consumption. So that's how the consumption value chain will play out, not immediately, but through this multiplier effect. Reality is real estate, or reality is a segment which is part of the consumption theme. Now here there are, you could look at it both ways. Firstly, the change in the taxation. So just because I did not highlight it in my discussion on taxation, the LTCG has been now cut on the real estate holding from 20% with indexation to 12.5% without indexation. So the indexation benefit that you used to get on the sale of real estate will now no longer apply. So some people view it as positive, especially those who probably recently bought real estate. They would any which ways not get much of an indexation benefit. So the 12.5, the lower tax rate, works in their favor. But somebody who's been holding it for a long time, who would have seen a decent amount of indexation benefit, would probably lose out on the capital gain side. So it's a mixed bag there. But government has been encouraging a lot of urban housing schemes, rural housing scheme, the PM Awas Yojana. So there's a lot of impetus there. In fact, government is also encouraging states to cut stamp duty. It is encouraging women to buy property with lower stamp duty. So those also will translate into an impetus for the consumption theme, a boost for a consumption theme. So overall, consumption as a theme will benefit more from the multiplier effect that plays out in the economy after the budget, rather than direct transfers that directly aid the consumption theme. And because India as a country has many drivers, right, from what I mentioned in terms of the population, the young population, the growing per capita, the shift towards digitalization, the shift towards, now culturally we are now more growing towards a society which is accepting credit, leverage, urbanization. All these parameters in a way build a good base for a consumption story. Already in the last, so we know that last 2-3 years, probably not all segments of consumption have been working. So consumer discretionary was working while FMCG was not working. Rural was not working, but urban was working. But I think over a medium to long-term period for a country like India with a very young population, consumption is a theme that will play out in our lives, and therefore it will play out in our portfolios also. So it's a theme that we are looking at from a medium to long-term perspective. We would also be having a launch coming up sometime on the consumption segment specifically as well.
All right, thanks for that, Divya. I think consumption as a theme really resonates across multiple demographics, right? Because
absolutely,
consider, like you said, the median age within India is 28, and say about almost over half, almost 67, almost 70% of India now has access to smartphones and the internet. So I think just by virtue of being on the internet, our consumption powers are increasing. We're consuming on e-commerce, quick commerce. We're purchasing. I don't think most folks would even resonate with the fact of going out and shopping, etc. Because everything is now the convenience that consumption offers you, right? So I think
Absolutely. And this convenience actually is now, I mean, it's not only restricted to urban areas, right? You go to tier two, tier three rural areas also, this kind of behavior is being seen. So there's no way that we can shy away from consumption theme.
yeah. All right. So, Divya, I think we have a few questions left. I think a few folks have joined the call a little late, and there is a recurring theme. Maybe if Divya, you could summarize your market outlook for debt equity and perhaps close with a quick summary on taxation.
Okay, sure, sure. So on the equity, like I mentioned yesterday, markets did have a knee-jerk reaction, but then came up and closed, marginally lower. We do think that one needs to be cautious on the equity market, more so because you cannot base your expectation of returns from what you have seen in the past. So you need to moderate that. The valuations across the segments are rich. uh, so the segments that have delivered on growth have a higher multiple, but there are segments that have not delivered on growth in the past and therefore are seeing decent multiples, like say FMCG, IT, or private banking sector. So these are cheaper in terms of, relatively cheaper in terms of valuation, but overall the markets are rich. From a medium to long term perspective, we are not worried about the Indian growth story, right? We are very anchored on how Indian growth story is. And there are multiple factors that are working for India, not just the GDP, but the way our corporate balance sheets are, the way our bank balance sheets are, the domestic demand capacity that we have. Corporates are healthy, profitability levels are healthy, capacity utilizations are growing. So all of these bode well, and from a medium to long term perspective, we are confident on the Indian growth story. But very near term, you need to be cautious. Any corrections you can take as an opportunity to build your portfolio. Um, so broadly, that's our view on the Indian equity market. On the fixed income market, we remain constructive on rates. So we know that the government is serious about fiscal consolidation. We know that India has a buy-in from FPIs because our bonds are now part of global indices. JP Morgan already, and few more in the pipeline, hopefully. So that will take care of supply. So there's a demand side from FPIs. Our external current account, our fiscal stance, both are decent and stable. So all of this gives us confidence to build duration in portfolios where we can play duration. Overall, we think in the next 3 to 6 months, interest rate settings can come off. And we could see 10 years softening in yields. So that's the view on debt market.
All right. Thanks, Divya. So I think we are almost out of time. Maybe if you just want to take a couple of minutes and run through, maybe not a document, but just give the folks a run through on taxation, because taxation, I still see a few unanswered questions on taxes. So if you would want to just summarize that.
Yeah, sure. I spend time on the capital gains taxation because that is where more or less the action and confusion is. So the aim of the government has been to firstly bring about a sense of uniformity in the taxation. So what it has done is, in terms of long-term capital gains, it has tried to have 12.5% long-term capital gains across all assets, all financial assets, as well as your non-financial assets. So that's how the taxation is, even for real estate or gold, physical gold and all, 12.5%. Now, what will differ is either 12 months or 24 months. Broadly, for listed space, say listed equity or a listed debt, it is 12 months of holding period. Anything if you hold more than that will be long-term capital gains of 12.5%. Now, for debt mutual funds, you have, if you buy it today, you will have no difference between long-term or short-term. It will be as per your tax slab. But if you had bought it before April 2023, then it is likely that you will have a 2-year holding period, after which you will have a 12.5% tax slab for debt mutual funds bought before 2023. And another important aspect is now, previously your international funds or fund of funds, gold, silver, all of these used to be taxed as per debt taxation. So it would be taxed as per your tax slab. Now, because debt mutual funds are specifically mentioned as those holding 65% plus in debt, these funds do not fall in that. So here again, you have the benefit of not paying your slab rate for long-term capital gains tax, but actually after 24 years, you get the 24 months, you get the 12.5% taxation benefit in the long-term capital gains.
Right. Thanks, Divya. I think we're out of time. Thank you for your time today and for answering all the questions. If you would have any closing remarks, and then we won't hold the folks here for longer.
No. Thank you so much. Thank you, Siddharth, for the opportunity. And I would request any investor here or any participant here who has few more queries that we could not address today in this call, please feel free to drop in a mail to us and we'll try to solve it for you. Thank you so much.
Thank you, ladies and gentlemen, for attending this today. We will be back soon with another webinar in this series. If you have any queries, questions, if you need any more information, if you want to consume any of our content, please visit axismf.com. You can download our mobile app, or you can follow us across social media. So thank you and stay invested.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.